Okay, I can quote tweet from here. Tom, how's it going? Before we touch specifically on this, how's it going?
Yes, good. You?
Yeah, I think we're good. I think we're good. Let me share this to the Twitter audience. Jobs that just dropped. Okay, okay, okay. Let's see, Johns, let me know when we start getting some viewers in. I will share the X link as well. On Discord. Did you post on Discord, Tom? The update? Or not yet?
Yeah, I have.
Okay, amazing. Let me drop this. To talk. Everyone. I'm going to post on Discord. How's it going in Dubai, Tom?
Yeah, it's okay. I've got a flight for Tuesday.
Okay, perfect. Okay, amazing. So, Johns, we're live on all platforms. Fantastic. I put it on Discord. I put the X link. Okay, Tom. Well, how's it going, mate? Hope you're well. Jobs data just landed. We'll go back and forth. We'll discuss a couple of things. We'll dive into some of the reasons why the data is the way it is. But tell me, what did the print say compared to what the print was expected to come in at?
So expectations were for a 4.3% unemployment rate, which it would have been unchanged from the prior month, and for 60k jobs added, which is it's relatively light, but it's still showing positive growth for jobs. So that's pretty good, and it would have meant that the Fed could focus on the inflation part of their mandate rather than the labor market part of their mandate, and they could target the situations or pay most attention to the situations going on in the Middle East and how much of an impact that's going to have on inflation, which essentially would have pushed rate cuts further out. And to be honest, I still think that's going to be their focus, despite what's come out today. What's come out today is that the labour market has shown more weakness, which is an increase, a tick up in the unemployment rate from 4.3 to 4.4, and then 92k jobs lost. So you're talking about the estimate being 60k positive and job losses of 92k now. So it's like 150k jobs estimate swing that they've essentially got wrong. This makes the situation for the Fed now a little bit trickier, even though it's only one print. So that's the main thing, is that it is just one print. It's not a trend as of yet. So they will look at it and be somewhat surprised by it. You're probably going to get the Fed holding rates in March, but Waller, Moran, both dissenting for a cut, and they'll cite this print. But ultimately, the Fed is going to stay on hold. It's like you can stay on hold for probably a decent period of time here, at least a few months minimum. Probably next cut won't come until late Q3. So that's how things have changed very slightly, is that the focus was solely on inflation, this conflicts in the Middle East, and how much that's going to stoke inflation, and how far that then means the Fed are going to push cuts out. But with the situation with the job market, you're now watching the other side of the or the Fed will be watching the other side of the mandate as well, with the markets now also focused on both sides of the mandate rather than just that inflation side. So it does make the picture trickier. And ultimately, this just isn't that good a setup for risk assets. Because the backdrop is so uncertain, they're not sure. The markets won't be sure which side the Fed will prioritize. In the near term, it probably prioritize the inflation side of the mandate, but longer term, in the coming months, it's probably been the case that should we see the labor market weaken further, for instance, a second, third print of weakness, the Fed might then transition and say, you know what, the inflation driven higher by the price of oil going higher, we're going to look through that. We're going to call that transitory. They probably they probably won't bring that word back out, but they go along those lines, and then they would shift to focusing on the weaker labor market. But at the moment, that shift is still on inflation rather than the labor market. If this was to go into a second, third, fourth print, they're going to then start maybe focusing on the labor market side, the weakness in the labor market, and then look to cut rates. But ultimately, for now, they're going to stay on hold.
Okay, that makes sense. For the layman, when we saw inflation issues and risks increase because of the Iran-US situation, with oil in particular, That was bad for crypto as a whole because it pushes rate cuts out as you need inflation under control. But when you have a weakening labor market, you want cuts because obviously people don't have their jobs. Now they've got two problems at the same time. You're saying the bigger issue is the inflation issue, and that's what they're going to prioritize, which is why cuts are going to stay pushed out.
Yeah,
Okay,
yeah,
how many?
that
You go ahead.
yeah, that's it. That's essentially right. It's just going to be the case now of which trends become stronger or weaker. And should the inflation side stay stronger, they'll lean into not cutting. Should it be the case they feel like the war is petering out, probably a bad way of saying it, but petering out in a month or two's time, and the labor market data, you might have one or two more prints by then for the labor market data, say they think the war is petering out slightly and the labor market data is sort of showing continued weakness, they would then probably shift from having a focus on inflation to then focused on maybe the labor market. With a lot of the members saying that they're still of the Fed still saying that they're modestly restrictive, they'll probably then look to do rate cuts, but gradual, slow rate cuts and small cuts, not 50 basis points, nothing mental like that, just 25 basis points cuts, and you'll probably then get two at least this year. Um, but should it be the case that you see, I think the setup, this sort of, I know the picture looks nasty at the moment, but I actually think this provides a greater setup for us in terms of opportunity going forward. Because I think, and we've not even spoken about this yet behind the scenes or anything like that, like this, but I think should you see inflation, stay higher because of oil and the conflict in the Middle East, I think it's just going to bring prices down further over the coming 1 to 3 months. Say, probably be good buying opportunities in there. But on the other end of that, you have the Fed staying higher for probably longer than they should have, or but again, that you won't be able to make that call until sort of mid later in this year. But essentially, you would have there would then be room because say in a year's time you have inflation in the low 1%, so 1.7, 1.8, 1.9, because this inflation in the coming months will be high, but it's driven up by oil, so you can see through it. Either way, that keeps the Fed on hold for longer, and it will likely mean inflation comes, but you sacrifice growth as well alongside that. You would then have inflation come down more rapidly once that sort of pass-through effect has happened. So sort of by end of year, early next year, and the Fed would then be at still 3.5, 3.75%. So it gives them a nice slope to really cut into, where you then probably go and get 4 cuts, something like this. So I think even though it might look not great now, it probably sets you up really well for late
Mm.
Q3, Q4 of this year, and then Q1 next year. So there's no reason why you couldn't go and get Bitcoin in the 50s in the coming 1 to 3 months, and then go and get Bitcoin back in the 100, like north of 100K, probably well north of 100K by end of year, early next year.
Okay, that makes a lot of sense. Obviously, our overarching theory that we've been pushing, our thesis, I should say, is we follow macro. We believe rate cuts are the big key determining factor of where the market's headed. We've been tracking it for a long time. And ultimately, more rate cuts, the better. And consistently over the last, depending on the cause of the rate cut, depending on the reasoning, but over time, these keep getting pushed back and back and back. The Iran-US situation, that made things even worse. It seemed like they'd be pushed back or maybe even less required, or even hikes. But this is a bit of a push in the opposite direction. But as far as the short term and then the super long term, nothing really changes. Is that what we're saying from this? And we kind of have to see another print or two come out to confirm
Yeah,
this.
no, yeah, nothing particularly changes off of the bat. It's just you just hold out longer. The Fed would just hold out longer, wait to see what the effects, sort of how strong the inflationary impact of this conflict in the Middle East would be. But they're still too restrictive. You know, their bias is to cuts, but they can't be cutting into rising inflation because of geopolitical issue. So they have to just wait for that to pass through and then cut later on. But ultimately, it's going to mean growth is slightly less. So you like unless productivity kicks in, etc. And productivity at the moment is good, but essentially it just means you're going to get the cuts, probably 4 cuts, but they're going to come later now. And the first cut for this year was priced for March, is now being priced to September. So or it was priced in September before this cut today. But either way, it's been pushed out dramatically already. So you probably still go and get those four cuts. They probably just come later than starting in March, which is what we priced for beginning of the year.
Yeah, absolutely. So as you've been saying for a while, price pain is in, and time pain continues and just continues to be pushed out. In simple terms,
Exactly.
someone who watched yesterday may have said, okay, well, in the job market's weak, wouldn't that pull cuts forward?
Yes, but again, it's about what they prioritize, and they can't, yeah, same thing. They can't be cutting interest rates to rising inflation. That's the near term problem. This is one print for the labor market. It's just
Yeah.
one print today. So if that was to be the case again, beginning of April, beginning of May, then they might say, Christ, this is now, we now have to actually shift from prioritizing inflation due to the conflict in the Middle East to then prioritizing because in 2 or 3 months' time, they might say that the inflation caused by the conflict in the Middle East is transitory. They won't say it's transitory, but they'll allude to it being transitory, and the fact they can start looking through that. So then they then would start prioritizing growth and the labor market. Should you see, maybe not by April, if you would see a bad print beginning of April, but if you saw a bad print beginning of April and then another one beginning of May, they would start really prioritizing it.
That makes sense. When is the next print due?
It will be the first Friday of the month, first Friday of April, first Friday. So, first Friday of April, first Friday of May. I don't know what the specific dates are, but it'll be the third or the fifth or something like this.
Okay, while we're here as well, could you give us a small education on the different types of job sprint? We obviously have the one we have today. We sometimes put out non-farm payrolls data. Could you give us a bit of an explanation on the different types of data?
In what sense?
When the labor market data comes out, like sometimes when I read your reports, we have non-farm payrolls data, right? And other times
Yeah.
we just get like today's print. What are they? What is different about them? I know like we include like key
No,
infrastructure positions and
no,
not
they're
times.
they're the same thing. They're the same thing. I will look at other things like participation rate, but the headline figures are the same. It's unemployment rate and non-farm payrolls. Though you can then look into the weeds and look at government payrolls, manufacturing payrolls, etc. Participation rate is also key. Like we had a drop today, I believe. Yeah, we had a significant drop today. So that again, that might aid the reason why the unemployment rate has gone up. But ultimately, you just look at those headline figures. You should be looking underneath the surface as well. Obviously, like there was elements of the Doge layoffs finally starting to come through, poor weather, but before that's then like filtered into this print now. But either way, it still led to a bad print. So that's the focus really.
Okay, makes sense. And ultimately, when someone is looking at the labor market from a distance, if they don't have the time to look at every key metric, you're saying just look at the top line unemployment rate and I guess the change from print to print, and then the
Yeah,
participation rate you said, but that's secondary as far as importance.
yeah, yeah. You can look at that stuff as well. Again, the main thing for the normal man, the layman, just look at the trend essentially, and again, obviously, it's our job to look in front to work out what's going on with oil, to then work out how that might feed into inflation down the line. I mean, it becomes quite simple at that point, but ultimately, you can just go and look at the data and then look at the trend to work out which way rates will go. But essentially, if you had a strong labor market data print today and this war showing real potential for longevity, then we would have higher inflation over the coming months. And it may then be the case, say the rate was at 3%, the market would then start pricing in the possibility of a hike being the next move. But you're not at that point. The labor market is showing weakness. The spike in inflation that we're going to see over the coming months is probably going to be something the Fed can sort of signal is transitory. And you're at 3.5, 3.75%. So there is room still to cut. They're just going to remain at this higher, slightly higher, or what they call modestly restrictive rates for a period of time whilst they assess how bad the inflation is going to be. And they still today's labor market print is just one bad print. So they've got time to assess the second and third print and work out other data between in that same time to work out the best way to shift it.
Yeah, that makes sense. If we look at the relationship between inflation and the labor market, when I look at it as someone who's not a macro guy, it seems that, hey, if the price of everything is going up, it means it's more expensive for people to be employing people. So I would assume higher inflation equals further unemployment. Is that too simplistic?
Yeah, no, it is the case as well. It's more the side of people spend less because people think things are expensive. They don't want to spend as much money, so they choose to spend less. Corporate revenues, company revenues, small business revenues would then be down, so they then might not look to hire, or they might, if they've got a staff of 12, they might look to reduce to 11, just because to try and sort of defend their margins. So it's more, I would say, it's more from that perspective.
Okay, no, that makes a lot of sense. I guess ultimately it would be nice to dive in and look at why unemployment is up. We've obviously seen a lot of big companies actually come out publicly and talk about how they've never been more productive or been more profitable. We saw with Nvidia, with record revenues coming in. Even for us at Cryptonary, to be quite honest, with even yourself, we are doing as good as ever with the smallest team we've ever had. And that's because of AI and the boom we're seeing here. So, what was the cause of this increase in unemployment? And is it something that can be easily nipped in the bud? Because, for example, if the typical response was to cut interest rates, making it easier to borrow, basically making the markets more liquid, giving businesses more bandwidth to hire people, even if you gave me a capital injection as a business owner, as an entrepreneur, I don't really have the desire to spend more money on hiring people. So I don't know if interest rate cuts or increased liquidity into the market will have as big an effect as it did in the past with fixing the unemployment issue.
Sorry, you cut out for a bit there, so I missed some of that question. But are you alluding to, or not alluding? You said in that part about productivity, like productivity in the workforce.
Well, okay, let's try again. Productivity is doing well, right? I was
Yeah.
curious, and typically down to AI from what we're seeing, from what we're hearing, we should say. So unemployment increased. I want to figure out why. And from there, I want to understand how it can be corrected, slash, if it can be corrected. Because if
Yeah.
typically it comes down to cut rates, more money is available, businesses can borrow more and hire more people. I don't know from personal experience and from what I'm seeing online if increased money and more accessibility and more capital will actually fix this unemployment issue because productivity is so high because of the AI. Seems like we're in uncharted territory when it comes to the relationship between productivity and employment.
I think it's just a transitional period. I think it's the similar to like the dot-com era. The dot-com era probably took away jobs, but it then created jobs beyond that. There was new jobs that came off the back of it. I think AI will do something like that as well, most likely. And you're in this transitional period now where the environment is just changing, and the labor market. So companies are adapting to it first, and then the labor market will adapt to it beyond that, because the companies will demand new people, new skills, etc. Um, so it's not a bad thing. It's a long term good thing. It's just very very choppy in the short term, and I wouldn't see that as too bad a thing. But it's just something markets will navigate. But again, it's just about positioning, and you need to go where the sort of, I don't quite remember what the phrase is, but where the puck is moving rather than so. And I'm talking from a labor market perspective here. If you're someone that's in the labor market, you need to position yourself to be valuable rather than to be. If you're a I imagine, like, I sort of read something the other day about junior consultants, and not that I don't think the consultants really like do much unless they're you've got to be a specialist in the field, sort of thing, rather than these like young kids that get hired as a consultant for business and they'll be 21. But I think those jobs are where it's going to really hurt. Junior lawyers, junior consultants, junior financial like experts, or just young kids that work for banks. Basically, I think that's where it's gonna hurt initially, but I think ultimately it just improves productivity, and then people are able to hire. If you have a team of 10 and everyone gets more productive, you might not need to expand that team to do the same amount of tasks, but those people are getting more productive. You can get more tasks done, and therefore you might hire in other areas to expand in other areas. So you might get job growth in other areas that aren't related to AI because your team are being more productive and getting more done. So it allows you to expand in another area essentially, because you don't have to take on, say you're a team of 10, you don't have to take on that 11th guy to do the sort of similar amount of workload. The 10 could just keep getting more productive. That allows you to hire in another area essentially.
Yeah, absolutely. That's why we're in such an interesting spot. I feel like I'm not a macro guy, Tom. You are the macro guy. You're the head of analysis for Cryptonary. But of course, I have to have a base level of knowledge when like working with you on your stuff. And the whole relationship between the labor market, inflation, interest rates, etc., was almost like the holy triangle of when we're looking at it, at least from a very, basic perspective, is a thing we need to keep an eye on. Like how does the change in each of them, up or down, impact the other two? And how are the others used as a control mechanism to kind of keep everything running smoothly? And right now, yes, we have the issue with inflation. You have the kind of back and forth, um, disagreement with rate cuts and keeping things the same. But the job market is the one that I find the most interesting because maybe it has the least impact on the markets, to be honest. Like we already spoke about how the markets can do well independent of people's experiences in the real world. But there's so many things that stem from this. Like I said, we as a company are more productive than ever with a smaller team. But that also means the moat between us and early stage startups continues to grow because we have the exact same tools they do, but with more experience. When you look at these companies at the top of the S&P, um, they're just going to grow further and further and further. And you're going to see, I think, harder for startups. I think there's an illusion that it's easier for people to crack into the market, but I don't see that as being true. So I actually think you're going to get an even widening gap between the companies at the top and the companies at the bottom. I think productivity is going to increase. I think that means more money will come into the market, I guess, at the top level from the people who do have jobs. Like we have to give pay rises to team members who are becoming more productive. It just makes sense. But we are also letting people off. So as you get more money coming in at the top because of increased productivity, you're also getting a lot of people who will lose their jobs, which I don't know what they're going to do. They won't be spending as much. Yeah, I don't know. It's an interesting time. I'd be curious to zoom out 5 years from now and say, what does the job market look like as a whole? Especially if you look back and you say, well, what kind of when's the last time we saw something like this happen? The Industrial Revolution, and I don't think we have data going back there. And then what happened? Like what situations reflects what we're seeing now? Is it when you see a massive change in minimum wage? Is it when we got to see like these machines where people are ordering burgers from McDonald's without going to see people at the desk? Like, is there anything we can reference and look back at? Because if it is all down to macro, I just feel one of the three pillars, being the labor market, is just in a different space. Like, who's to say 10% unemployment is a bad thing? We would think it's bad. We would think going from 4.4 to 4.8 in the next 6 months is a bad thing. You want to see the labor market increasing, but it's no longer tied to productivity completely, one for one. Anyway.
No. I just think we're in that transitioning period. I think it's similar to the dot com, to be honest. I think, again, I would have to really look at the metrics for it, but it created a lot of jobs and it created a lot of teams got more productive, which just allowed companies to hire in other areas where they couldn't, use AI, or they would go out and do sales because they're they're building the software or they're building the back end of the business out so much better that they can now complete tasks faster, and therefore they're trying to up their sales. So they're going out and hire more salespeople. It might just be in ways like this. So I think maybe you then go and get more the as it becomes more and more difficult to go and get those junior lawyer, junior consultants, junior financial whatever jobs, people then might start to say, okay, well, I'm going to like pivot more into the trades jobs, so electricians, all along those lines. So you might get an increase in those areas, and you might get. I think it's just a shift. I don't think it's gonna. I think when you're in the transitional period, I think there is going to be that period where there are some losers, but like I don't think that lasts, for 10 years. I think that lasts for maybe a couple of years, and well, probably longer, because you get the people going through universities realizing, maybe my degree is not really worth anything, and okay, even if it is worth something, does it actually reward me with the job at the end? So it's just very tricky. But I think it's the same as anything. You just got to try and be smart and assess for yourself where the puck is going, and anticipate that, and make the relevant shifts for yourself. And just because you've studied something or put time in something does not mean you should keep, um, banging on that drum, because you've spent time on it. It might be the case that that job is becoming slowly irrelevant. So again, it's just about, I think, trying to be smart, anticipating it, and going where the puck is going, not where the puck was.
Yeah, it makes a lot of sense. It's very, very interesting. I guess we are a crypto company. We are not a traditional stocks, like a stock picker or anything. Obviously, you're very in touch with macro. I know you keep an eye on the S&P, the Nasdaq, etc. We are officially 1 for 1 with our stock picks, thanks to the circle play. If you want to zoom out and look at, the different sectors and industries out there right now, which ones look ripe for investment? And which ones would you say to sit back? Like, people are always going to need food, right? So it's when you look at these giant companies like McDonald's, Walmart, etc., there seems to always be demand there. You look at what's happening with this war in the Middle East, you would assume companies in that sector will do well. But you would also see, with, like you said, junior lawyers, etc., these, consulting companies, these, tech startups, these would be the industries that would be most affected. As an investor, what sectors are you looking at for opportunity, and which ones are you like, I will not touch that with a 10-foot pole?
Um, it's very, very difficult. I think in terms of being a long-term investor, like multi-year, I think you have to be like on the AI trend. Um, it's very difficult because this isn't my specialty. My specialty is working out macro conditions, liquidity, to then assess what risk assets, and mostly Bitcoin crypto, is going to do, and I'll work out Bitcoins and work out what 99% of all coins are going to do. But if you was to see a consolidation in gold between 4,800 and 5,200 for the next 6 months, if you can buy towards the bottom end of that range for a move up to 6,000 in the next 9 to 15 months, that something like that is a good longer term trade. Um, in terms of like actual stock picks, just again, it's just not my forte really. Um, yeah, that's what I'd have to say. Is my specialty is more macro, on chain, and trying to figure out Bitcoin rather than stocks. But I'd still be of the view that I think Bitcoin can still do very well over the next like 12 to 18 months. I would say we're 4 months into a bear market. Obviously, extremely hard to know back in sort of October time that you're going into a bear market, but you can then sense, once prices come down a bit more, that there's not the buyers there anymore. Liquidity sort of peaked in mid Q4. Um, we see some work that the business cycle is ticking up and ISM is going higher, so Bitcoin will go higher. It's just not true. That's a crap take. Bitcoin is not tied to the business cycle; it's tied to liquidity, and because the business cycle is picking up, that means liquidity is decreasing in financial markets and moving into the real world economies. That's good for that's the business cycle. That's that picking up, but it's not good for risk assets like Bitcoin for the time being. So, and that's the situation for the time being. So I wouldn't look at the business cycle ISM, even though I've
Yeah,
seen work like that out there.
well, that makes a lot of sense. If we see the non-farm payroll print also come in negative, would the Fed consider cutting even with oil at 80 plus dollar, or would they just sit back and watch, and potentially see everything blow up?
No, they would. They would just they would still cut. They would, again. It's going to have to be the case that you see three bad prints for the labor market. So first one today, beginning of March, beginning of April, beginning of May. If you got three bad prints and you saw oil price spike, so it depends. If in April, May, oil is, Brent crude is at 120, that's then a problem. They've then got a real problem on their hands. But if it's the case, it's spiked to 100, 110, and it's then pulled back to 90, 85, they might then be saying, okay, well, we're still expecting inflation to come down or trending lower because inflation is now spiked because of the oil spike, but the conflict in the Middle East is coming to an end in the coming months. Again, this is all so dependent on what goes on. But they would then, under that scenario, they would then choose to look through the inflationary impacts. Even though the prints would be bad, you'd probably then start seeing the prints coming down from, say, April, May, from like May onwards, possibly, maybe a bit longer, maybe like June onwards. Um, but they would shift to focusing on growth in the labor market if they had three bad prints there.
Okay, that makes sense. It's very interesting. Right now, Bitcoin is at 68.5. Seems to be down a couple of percent since his data come out. I'm not sure if it's directly tied because we've been trending down for the last 24 to 48 hours. Earlier in the week, we saw 74K get hit. And we have been of the mind that this is a short-term relief rally. We did say we could see, 78 to 80, but then we saw a lot of weakness yesterday, and that continues to happen. We've said we think 50s to 60s could be on the table. However, do you see further rally over, let's say, the next few days or even weeks, and then the pullback, or is now the grind down to the 50-60 range what you're expecting?
I did think we could rally like midweek Wednesday sort of time. I did Monday, Tuesday. I was very skeptical, and then it started moving, and you saw relative strength in Bitcoin against the Nasdaq sort of Tuesday time, and I then thought, okay, this can have a breakout on the Wednesday. But then you see it move into 74K. It then rejects there, and then I was looking yesterday at Thursday for it to hold the open between sort of mid 71s, mid 72s, and again, it's just not done that. It's in the low 63, 68s now. Sorry, it said 68 300, so I said 63s, but it's in the low 68s now. It's like well back in the range now. So again, I think it's just going to chop. I think this is just going to chop for a while. I think the the normal person is best off not trying to trade. Even me sitting here every day, I'm probably best off not trying to do too many trades here and just buy the bottom of the ranges, anything sort of 63 and below for a move up. And if it breaks down below 63 and goes into the 60s, be much more aggressive with my buys. Especially if it gets below the production cost at 59K. You got realized price, I think is tilting downwards, so I think it's like 55. But if you were to get those levels, I think you just got to go for it. So I would say we've got chop ahead of us, most likely. Don't get chopped up by the chop. Just let it happen and try to accumulate at the lows, especially if you get low 60s, you can start getting in. But mainly your major buys for the real long term should be in the 50s. And I think I'm pretty confident we get it. If it's next week, probably not. But if it's in 2 months' time, I'd say somewhere between now and the next 3 months, somewhere like that. But I'm pretty confident we'll get it.
That makes sense. I will say, because for a long time you've shared your conviction zone for where we're headed is 50 to 60, right? Let's just put that there. 50 to 60, let's keep it quite wide. Now, when we first started calling for this, we were under very different circumstances. There was no war kicking off to this degree. We didn't see this happening with the labor market. No one foresaw this happening. Be curious to see what the poly market odds for a print like this were at. What would invalidate your thesis? Where you're like, you know what, we didn't hit, or we're not going to hit 60 again, or even if we do, maybe we get high 50s, but we bounce. Share with me what you'd have to see to invalidate your thesis.
Um, I think it'd be something along the lines of just like relative strength. If equities then started making new lows and Bitcoin kept holding like the 64, 63 level, um, if there was an escalation in this war, I think equities are still not pricing it properly, to be honest. I think they're expecting um, this to be resolved in a few weeks. I don't think this is going to be resolved in a few weeks. That's why I think oil consolidated in mid 80s, which we sort of said and called for, and now it's breaking high today. Like that's Brent crude. Yeah, Brent crude's 92, so that's right up. I think that's off the back of the Kuwait news, though. Anyway, um, I, I would be looking for something like that for there to be like real relative strength in Bitcoin against the indexes. Should like TradFi indexes, should S&P, Nasdaq, etc. really break lower and Bitcoin hold up in the early to mid 60s? I mean, if it held up at 67, 68, I'd be gobsmacked. But um, that would be, I think, the thing that mostly invalidates my thesis. But um, I'm pretty confident, to be honest. All bear markets have seen price go below the realized price, which is 55. So I think, and they've all spent money, at least several months below the production cost, which is currently 59. And that was me checking it 2 days ago, 3 days ago. So I think that now might be like tilting into the 58s. Either way, it's tilted lower rather than production cost tilting upwards. So it's only going to get lower. So I imagine prices just dragged down by that. It's disappointing because I did think we could go and get a decent breakout to like 76, mid 70s, with there being a load of the on-chain cost basis between 78 and 84. There's quite a few. There's the ETF cost basis. There's true market mean. It's 128-day moving average. I think short-term holder cost basis is like 84, 85, I think, something like that. It might be 86, but it's there's quite a few in there. So I thought we could get rally into at least the lower bound of that 76, 78, somewhere like this. But we haven't even been able to get that. I think I think today is the day that the market starts pricing in crap. This war is gonna last longer than we think. So again, I've gone a long-winded way about that, but in terms of what invalidates it, I would say relative strength against the TradFi index is really sort of majorly pulling back. But to be honest, I am maybe I'm overly confident. I don't know, which is probably not a good thing, but I just feel quite confident this is going to. I would be if you ask me the question, is the low in for Bitcoin like that 60,300 print or whatever it was? I'd be gobsmacked if we don't take that out.
Okay, that makes a lot of sense. Well, thank you, Tom. Obviously, we came here to talk specifically about the labor market data. I do want to ask you a couple of questions regarding the Iran-US situation, as I feel since yesterday's conversation, there have been a few escalations. But before we do, let's use this point in the conversation as a bit of a checkpoint. And if you could re-summarize the labor market conclusion, what we just discussed, your take, expectations, etc. Pretty much what you put in the pulse.
So the labor market came in much weaker than estimates today. The market was very focused on the inflation impact in the Middle East, so that pushed Fed rate cuts out further. The labor market came in really weak today, but it was only one print. So whilst the Fed is probably going to stay focused on the inflationary impacts of the conflict in the Middle East, they will now have, their other eye sort of watching the labor market weakness. But again, it's one print, so they'll want to see it become a trend. Another print or two. So they probably wouldn't start prioritizing at least until early May upon that print, should you get a third bad print in early May. But in order to prioritize that, inflation would have to be sort of topping, or oil would have had to have topped and come back down, and for the situation in the Middle East to show some sort of solution, or even if it is still kicking off in the Middle East, that the oil flow is back rather than the Strait of Hormuz is effectively closed. So the labor market print today didn't change too much, but other than the fact the Fed and the market shouldn't be completely and utterly focused on the conflict in the Middle East, and should only be maybe for now 85% focused on the conflict in the Middle East, and should have a small eye looking at the labor market side of things. But not for today, for the coming weeks and months, for the next 2 months, I'd say.
Yeah, that makes sense. Okay, fantastic, Tom. Thank you for that. We'll touch on Iran-US situation very quickly, as there has been some escalation since yesterday. I see around 30 minutes ago, pulling from Bloomberg, Trump says he wants unconditional surrender and he's not interested in a deal at all. Now, a lot of this could be posturing, but if this is the case and he's serious about this statement, does this impact your view at all? If a deal is not on the table, if this is full-blown war, and we already discussed how likely is unconditional surrender, Does this impact the markets? What are we expecting here? Because this is very different, a 3-week time horizon versus a 3-month time horizon regarding the Strait in particular.
No, so I think the market's coming around to that today. But again, we said on the stream yesterday and in prior days that this is looking like it's going to drag out for longer. The Iranian regime is not one that's looking like that they would do a deal because of their religion. And how like sort of extremist their religion is. So I don't expect a deal to be done. Trump and the Israelis have gone, or the US administration and the Israelis have gone as far as they've gone now. I think this is just going to be regime change or nothing. And for that, like we said yesterday, it's going to probably require boots on the ground. Whether it's probably not going to be Americans, but it's probably going to be the Kurds, backed by the US military. But not backed by boots on the ground, US boots on the ground, but backed by um, air power, for instance. So yeah, this is going to be more drawn out. I think the market is coming round to this realization a little like more today, but I think it's going to really sort of feel it next week. I mean, yeah, the Nasdaq's down 1.6% at this moment in time. So I think these indexes are rolling over now, to be honest.
Yeah.
I wouldn't look to be a dip buyer at all. Well, I think these need to have a 10% pullback.
Mm. Um, I I agree. That makes sense. Yesterday on stream, for our CPRO stream, Brent crude is at 83. We're around 91, 92 right now. It's a big move very quickly in a singular day. Are you expecting this to just to continue surging? And if so, how far away is $100? Or do you think a quick, pullback is probably on the table? As the people will always look to trade as well. People are
Yeah.
trading these positions. So yeah, what are you seeing for oil as we go into the weekend? Because this is when typically Trump kicks off too.
Yeah, I think it would just. I think you can get these like whipsawing pullbacks, but I think it just trends higher. Um, you're going to get like Kuwait has begun cutting production today now, so there even though they're still producing, like a lot of these countries are still producing, they're going to reach their sort of stockpile limit or their capacity limits. So I think this is going to get worse before it gets better. Don't get me wrong, I don't think this is like a 4 month. I don't think oil is higher in 4 months time. I think it peaks in the coming weeks, month or two, absolute latest. um but yeah, that's where I think and Trump will try to bring the oil prices down, but I just don't think he can do that much about it when ships are just choosing not to pass through the strait. So I think it goes higher, but it might get whipsawed lower today or something like this, but generally it's going to trend higher over the coming week. That I'm comfortable calling that.
Yeah, no, it makes a lot of sense. Yeah, Tom, I think we're in a very interesting spot. Thank you for the breakdown regarding the labor market. I think we should do more of these. I think they were quite good. Well, I told you 10, 15 minutes, we're 40 minutes deep. But any final comments you want to make in regards to macro, on-chain, mechanics, etc.?
No, I don't think so.
Okay. Thank you very much, Tom. Appreciate it. Mr. Producer,